Hey guys, how you doing? Hope you're well. With a quick update for you on the markets. Guys, as you can probably tell from my voice, I'm in an enormously good mood today. The markets yesterday tanked. They absolutely got slaughtered. And we'll talk about this in a few moments in this video as to the reasons behind it. But guys, let me just say this. Take a look at this chart. This chart, I mean, there's only one word. There is only one word to describe this chart, which is
beautiful.
Exactly, beautiful.
Delicious.
Delicious? Yes, why not? Let's go with delicious. Because guys, I am drooling. I'm absolutely drooling when I see this chart. So let me explain to you why. As you may remember from a couple of weeks ago, I posted a video, and you may remember in that video what I said. I showed you this chart of the Russell, and I said, look, the Russell, the small cap stocks are coming to an important level of resistance, that trend line. As you may recall, the stock market was touching this level, and I said, look, I was itching.
The itch eraser.
I was absolutely itching to short this market once we get a reversal signal. Well, guess what? We did get the reversal signal just a few days afterwards, as you can see there. And as a matter of fact, since then, pretty much the market just tanked, just dropped. And you may remember in my most recent video at the markets, I said this. So as I said in that video, I said if the markets take out that support, boom, we're going lower. In fact, that's exactly pretty much what happened here yesterday.
Savvy.
Now, before I explain some of the reasons as to what's causing this drop in the stock markets, let me first of all mention this. In our member videos, we've actually been expecting this downward move in the markets because we've been anticipating this downward move in the markets. In fact, just a couple of weeks ago, this is the video I posted. This is our member video from a couple of weeks ago. And I said, look, the market's dropped here, but very likely we could see a pullback, a 61.8% retracement to the golden ratio, the Fibonacci level here, and very likely we could see a downward move from that point. And pretty much the S&P did that to the letter. As you can see, there was a pullback to the 21 moving average on the 4-hour time frame, did it twice as a matter of fact, and then boom, it tanked. So that was the S&P. And let's go back to the chart here of the Russell. So you may be wondering right now, well, what's bringing about this volatility right now? Well, let me just say this. If anyone tells you that the reason why the markets tanked yesterday was because of the whole impeachment process, guys, there's only one response to that nonsense. Exactly. No, guys, one of the major reasons, in fact, what's probably causing a lot of panic in the markets is this. You may remember about a few weeks ago, I tweeted out this chart, and actually I mentioned this in my video. I said there's a recipe you need, a cocktail recipe for a recession. You need 3 things for a recession. The first recipe in your cocktail is going to be this: the Federal Reserve cutting rates. The Federal Reserve made another cut to the interest rates, and guess what, guys? That is not good. Because every single time when the Federal Reserve has been raising rates and then starts cutting rates, that is a dangerous sign for the economy. In fact, if you look back in the past, every single time when the Federal Reserve has been raising rates and then cutting them, that has been a major economic sign of a recession. Happened in 2008, happened in 2000, the 90s, 80s, the 70s, and so on and so on. So that's the first cocktail mix you need. The second, as I'm sure you probably know by now, is the inverted yield curve, which we already have. As you may know by now, the yield curve has inverted, as you can see from this yellow chart. And guess what? Whenever the yield curve becomes inverted, goes negative, that has also led to recessions within the next 12 to 18 months. Happened in the year 2006, 2007, and then the year 2000, and so on and so on. There's a third thing you need as well. The third thing is the manufacturing PMI, which goes below 50. Again, this was in my tweet about a couple of weeks ago. You may remember I mentioned this, which, as you can see here, I showed the PMI chart. The reading went below 50, a major sign of a recession. This actually happened back in the year 2007 and in the year 2000 as well. So what happened yesterday that caused a lot of volatility and panic in the markets is that the latest PMI reading, the latest economic report on manufacturing PMI reading came out, which was even worse than the previous reading. So we now have one of the worst manufacturing PMI readings since 2009, guys, 2009, as you can see here. Now, some of you may look at this chart right now and you may object.
Objection, Your Honor.
And you may object and say, well, hang on a second. What about these two negative readings, these 2 readings in green from 2016 and the year 2012? How come they were not leading to recessions? Well, the fact is, guys, remember, you need a cocktail mix. We're not just relying on one single economic indicator. So we're relying on 3 things, as you may recall. And let's just go back to it one more time. Fed cuts rates, check. Inverted yield curve, check. And the manufacturing PMI goes below 50, check. So the difference between now and the previous 2 false signals, as you may remember from the 2012 and 2016 readings, is that we now have a cocktail mix of 3 things happening at the same time. So that objection is therefore overruled.
Overruled.
All right, guys, so in my next few videos, I'll go into this in a bit more detail. But the fact is, guys, this is not looking good for the markets. This is not looking good for the major stock markets. And I think, look, guys, brace for impact, because after yesterday's fall, I think we could see further downside pressure here in the stock market. It's just the beginning, in my opinion. One important thing I want to mention, guys, is that remember, the month of October and September are usually very volatile months. I mentioned this a couple of weeks ago, so expect a lot of volatility as we go into the month of October. That means this, it means we need to be very careful, because in volatile periods, yes, you may have very strong down days, but you can also have very strong up days as the market takes its course. All right, guys. So I mentioned this because a lot of people think, oh, because the market's dropped, that means we can go and short the market. No, absolutely not. This market is going to be very volatile. It's going to be a lot of up and downs. It's going to be very risky. Be prepared for these very risky and volatile moves in the markets as we head through the next few weeks. By the way, guys, before I finish the video, I just want to say this. Very soon, I'm going to be doing a webinar, a free and live webinar on how to prepare for the next recession. So in my next video about the financial markets, I'm going to give you the link to register for this particular webinar. If you've already received the link in your email, then please go ahead and register. But if you've not received the link yet, then I'm going to give you the link in my next video update. All right, guys, thanks very much indeed for watching. Again, please remember to subscribe, and also please hit the bell icon for future video updates. Thanks a lot.